Welcome to an overview of the budget and the budget process. In this introduction, we'll define several key terms and then answer several questions such as, what is a budget? What is fiscal sustainability? How to reflect time in looking at a budget? And what are the basic calculations in doing budget analysis? A budget provides a framework to allocate resources among competing choices. Accounting provides a standard technical language as well as a set of procedures for correctly recording, summarizing, interpreting, and communicating the results of financial transactions. There are hundreds or even thousands of financial transactions in the course of a year, such as the collection of a fee from a service user, the purchase of a box of needles for the laboratory, paying the weekly salary of a public health nurse, or paying monthly rent on the building. Each transaction must be correctly attributed to the proper organizational unit, such as a lab, that may be part of a public health unit which also performs other functions. Let's say the goal is to determine how the revenues and expenditures match for the laboratory unit. Therefore, each financial transaction should be supported by documentation, either in physical or electronic form, and entered into a record system that is able to generate a summary of all transactions for the lab. This sorted and summarized information is then available for interpreting and analyzing the laboratory's budget position for those who have a need to know this type of information. We make accounting data available to others in a timely and useful format through financial reports. The budget is just one type of financial report. Another would be the end-of-year financial statement or the audit. There are others, though, such as daily cash flow reports, budget status reports, and other internal or managerial reports. The auditing process is to ensure accounting and financial reporting elements are functioning properly. Normally, there is a financial audit prepared at the end of the year to see if, for the entire 12-month period, the organization properly recorded transactions, covered its expenses with income, and whether the organization is financially healthy. The 12-month period is termed a fiscal year, for which we are developing a profile of our finances. A fiscal year could match the calendar year, starting on January 1 and ending December 31st, or it might start with some other month, such as July 1 and end June 30th in the following calendar year. A budget sets out the revenue and spending plan for the fiscal year. It is an estimated price tag to deliver a planned level of services. But the income upon which the spending plan was premised may not always materialize. Thus, if a revenue shortfall becomes obvious during the year, prudent management says to start cutting spending so that at the end of the year, there's a balance between whatever the revenue numbers are and actual spending. The budget can also influence the economic behavior of individuals and organizations. Higher fees may discourage people from using the service, while lowering the fee may encourage more use. Higher spending may discourage external grants by conveying that your cost of service is too high. Paying lower salaries than competing organizations may make it harder to employ workers. As a result, every budget choice must be thought through because it could lead to the wrong incentives and disincentives. Budgets force decisions among many competing options. There are winners and losers in budget allocations. Do you spend more money to buy supplies or to pay higher wages? What type of supplies? Who gets the wage increase? These are the types of difficult choices reflected in budget allocations. Management experts say that people are motivated by having a measurable goal that is achievable but not too easy to make. It should be a quantifiable goal that is stretchable. Well, the budget is ideal for that purpose. As a manager of a unit with a budget, the service goal is to deliver a certain level of services at a budgeted cost. The financial goal is to keep spending within the budget, and if there's a revenue goal, it's to collect that amount. Although budgets do not constitute legal contracts between the organization and its manager, the budget does convey expectations of what managers should do in terms of their financial obligations. There are mutual obligations. Therefore, we might consider it an implicit contract on what is supposed to be good fiscal management for the year. If you say you can provide the services for the price tag, you must deliver the services for that budgeted amount. Budgets reflect cultural preferences too. People want services, but they don't always want to pay for those services. The objective, ability to pay, is different than willingness to pay. Ability to pay is based on wealth, income, or some other determination. In contrast, willingness to pay is a preference. Even wealthy individuals prefer to keep their wealth and not have to pay for services. Therefore, the budget has to reconcile these considerations. Fundamentally, budgets are expressions of power. If the budget is for the government, the plan depends upon political power. Who prepared the budget? Who has the power to approve the budget? What are the choices that are funded? And who is expected to pay for those services? Even when the budget is for non-governmental entities, there is organizational power exercised by those in leadership positions. Frankly, those who make and control the budget exercise power over those who have to live with that budget. There are two types of budgets. The annual operating budget provides the revenue and spending plan for the fiscal year. It's based upon providing an estimated level of services to the community. It covers the recurring or ongoing operation and maintenance expenses of a laboratory. Examples include salaries, wages, supplies, rent, utility charges, and phone bills. The purchase of small pieces of equipment that have a low price tag and are replaced almost yearly would also be covered in the operating budget. Very expensive and long life projects are typically handled separately in a capital budget because they have to be scheduled out over time. The price tag for each item may be too high to cover with existing revenues. The organization may have to borrow money to buy or build, or it may have to seek external grants or donations to acquire the desired item. Capital budget items would include buying or building new buildings, or possibly for land acquisition. Large and expensive equipment that is expected to last longer than 1 year would also be considered a capital project. A budget is built on estimates of the inflows and outflows of money and what those amounts of money represent. While the amount of income that flows into the organization, also referred to as revenue, is important, so too is who pays. Do the service users pay, and/or does the money come from the central government or donors? Thus, the source of money matters in planning the budget. For example, how likely is the money to come in as expected during the year? A good forecasting or estimation process is needed and will be discussed in a future module. The outflow of money is termed an expense or expenditure. Just as you have to estimate the inflows of money, you have to estimate the outflows of money and make sure inflows exceed outflows almost daily. Who benefits from the services produced from the expending of this money? Are the beneficiaries the neediest, or those who just happen to come to the clinic? Matching the inflows of revenue to the outflows of expenditures produces a balance, a surplus, or a deficit. Surplus in 1 year can be used to save for a time in the future, perhaps next year, when the annual budget runs a deficit. In contrast, if there is more expenditure than revenue, the organization often has to borrow money to cover the difference, thereby creating debt, or it may be able to draw down its own saving. A balanced budget is where revenues equal expenditures. But are the revenue expectations built on existing revenue sources and rates? Or is the budget premised on higher fees, or a new revenue source or tax? Are savings from prior years used to balance the budget? If the latter is true, then this use of savings cannot continue indefinitely. At some point, savings will be depleted, and there will be nothing else to balance the budget with. Other questions to be asked: does the budget have to be balanced when it's first presented by managers, or when it's formally adopted by whomever has the responsibility? Does it have to stay balanced throughout the fiscal year, or does it just have to be balanced at the close of the fiscal year? The time point or points in the year for which the budget has to be balanced can and will impose controls on managers. These balanced budget requirements are usually defined by your organization, such as the Ministry of Health, or by law. A budget is sustainable over time if spending trends are less than revenue trends. Otherwise, there's an imbalance that has to be corrected through either higher revenues or lower spending, or some combination of the two. For example, is the lab's cost per HIV test increasing while reimbursements or fees per test remain flat? If so, then continuing to provide HIV testing at a loss will deplete money available for other services. Sustainability is where future generations are not negatively affected by current budget choices. As an example, depleting underground resources, such as oil deposits, to benefit current residents leaves nothing for future residents. To offset that problem, many governments put the income earnings from extracting resources from the ground into a dedicated permanent fund, with only the annual budget using interest earnings from that accumulated money in the permanent fund. In this way, the permanent fund will continue well into the future, so that future generations will get to benefit even though there are no more underground resources to tap. Budget documents serve internal management purposes, but government budgets should meet high standards of transparency and full disclosure. The budget document provides policy guidance on what choices have been made about the services to be offered during the year, and how those services are to be paid for. The budget document provides exact details on the amounts of money for each service use, as well as each revenue source, therefore it's considered a financial plan. A well-designed budget gives non-financial information on the operation of each service as well, such as the number of expected users of the service during the year, other indicators of demand or need for the service, and performance measures on the efficiency and effectiveness of the service, both in the past and for the budget year. A well-crafted budget document also is a communications device, in that it offers readers a way to understand the financial affairs of the organization.